The math proves that weekly options aren't just faster monthly options. They act like a completely different asset class with 300% higher gamma risk. Most traders treat expiration dates like a calendar preference, but this destroys portfolios. The choice between 7 days and 45 days dictates your entire mathematical edge. It is a choice between income velocity and portfolio stability. Let's look at the structural differences immediately. Weekly options offer rapid feedback and faster compounding, but they suffer from wider bid-ask spreads relative to their value. Monthly options provide liquidity, tighter fills, and more room to be wrong. The primary allure of weeklies is theta, or time decay. The decay curve is exponential, meaning an option loses value fastest in its final days. Sellers love this because they want the price to go to zero quickly. However, this creates the theta trap. While the theoretical decay is highest in the last week, the realized decay is often disrupted by price movement. You are trying to harvest value on the steepest, most slippery part of the slope. This brings us to the hidden cost of weeklies, gamma. Gamma measures how fast your delta changes. In plain English, it measures how quickly a calm trade turns into a disaster when the market moves against you. Mathematically, gamma is inversely proportional to time remaining. As time vanishes, gamma explodes. This means a 1% move in the stock might double your loss in a weekly option compared to a monthly one. Visualize a weekly trade like a speedboat. It's fast and agile, but if you hit a wave, you feel every bump violently. A monthly trade is a cruise ship. It takes longer to turn, but small waves don't spill your drink. Here is the risk comparison. At 7 days to expiration DTE, your touch risk, the chance of the stock price hitting your strike, translates almost immediately into a full loss. At 45 DTE, a touch is just a warning sign. This forces a different management style. Weekly options require precision trading. You must be right about the direction and the timing. If you are wrong, you have very little time to roll or adjust the position. Conversely, monthly options allow for process trading. This is the standard 45 DTE method. You enter the trade, and if the market moves against you, you still have weeks of extrinsic value protecting you from assignment. Let's break down the monthly management cycle. You enter at 45 days, and your target is to manage winners at 21 days. This avoids the gamma zone entirely, capturing the bulk of the decay without the explosive risk. If you trade weeklies, your decision tree is much harsher. You cannot simply wait for a rebound. You must use tight stop losses or accept assignment, because rolling a weekly option often yields very little credit. So how do you choose? It comes down to your screen time budget. If you can watch the market all day, weeklies offer more occurrences and faster compounding. If you have a day job, weeklies are dangerous. We also need to map strategies to timelines. Directional speculation works great with weeklies because you want to get in and out. Income strategies like iron condors or strangles need the stability of monthlies. Another critical factor is early assignment risk. In monthly options, OTM, out of the money, strikes rarely get assigned early. In weeklies, dividend risk and pin risk become major headaches on Friday afternoons. Let's quantify the liquidity difference. Monthly expirations generally have 10x the open interest of off-week expirations. This slippage on entry and exit can eat up 10% of your potential profit in weekly strategies. Here is the ultimate trade-off. Weeklies provide higher theoretical annualized return, but with much higher variance. Monthlies provide lower theoretical return, but much higher probability of profit. If you are building a core income portfolio, stick to the 30 to 60-day window. Reserve the weekly options for sniper shots, specific events like earnings, Fed announcements, or technical breakouts where you expect an immediate move. Remember the gamma hammer. If you sell weeklies, you are picking up pennies in front of a steamroller. If you sell monthlies, you are picking up dollars in front of a slow-moving tractor. You have time to move. Final recommendation: start with monthly options to build your bankroll and learn defense. Only graduate to weeklies when your management mechanics are flawless and you can afford the volatility. Choose monthlies for consistent income, weeklies for sniper entries.